Well, it's tough. I've always said that in the short run, it's really hard to tell what's going to happen to commodity, and particularly oil prices, because the supply-demand imbalances can move quite quickly. However, over the longer run, because the major oil producers, whether we're talking about the Middle East or Russia, have really failed to diversify their economies, they are dependent on oil exports, and in the end, supply is going to continue to remain high. And so then you get the questions of, well, supply now, we're talking about a slowdown in global demand. We saw some Japanese GDP numbers that were weak. And so now there's the thought that maybe through 2019, we're going to see less demand. So it's not surprising to me that in that environment, oil falls. In the short run, it's a political story on whether OPEC can get together and agree to the necessary supply cuts to drive prices back up. They can definitely do that temporarily. They cannot do that for long periods of time because they're reliant on oil revenues to spend, because they really are still running fiscal deficits.
Yes, Stephen, I agree with you. I think the demand story is starting to play more and more of a role here. Considering that fresh data we got out of Japan, but also somewhat of a mixed picture once again from China. I mean, in Beijing, authorities continue to flag that they will support the economy as these trade tensions linger on with the U.S. But is it going to be enough, not just to support the Chinese economy, but really the broader region in the EM space, given that China is still the anchor for a lot of Asia EM?
Well, look, I think the Chinese growth has maybe slightly underperformed the longer-term expectations when we go back to 2010 and the 10-year plan of doubling per capita GDP growth, which really meant somewhere in the order of 7% annualized growth from 2010 to 2020. We're a little bit under that now. They've done a good job to date, and really they're moving back toward that export-led demand, which is a problem right now in the trade war rhetoric. Well, obviously the currency is weakening, and that'll help somewhat alleviate the story. It's a question of how much further that can go and how much they can continue to rely on that export given the trade war. And I think that may last quite a bit longer than what markets are anticipating at this point.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.